My name is Lynne Sagalyn. I've long been associated with the business school, and now I get called on to do these kind of wonderful panels. This is a panel, as you know, and why you're here, on opportunity zones and community development financing. I'm just going to say a few words, a few sentences about opportunity zones, and then introduce our panelists. Congress created this Opportunity Zone program as part of the 2017 Tax Act. The intent was to funnel investment to economically distressed neighborhoods in targeted zones, defined targeted zones. Under certain conditions, these investments qualify for preferential tax treatment, and I would say probably very preferential tax treatment of capital gains. And I want to read you a little excerpt from the recent Brookings report on the program. Quote, while the program was intended to target distressed areas, eligibility was broad. 57% of all neighborhoods in America qualified, and not all were truly distressed. State governments, which had broad discretion to select qualifying areas, faced a conflict between selecting deeply distressed areas versus already improving or gentrifying areas that were more likely to provide tax benefits to qualified investors, unquote. I offer this quote because designing these kind of programs is not easy. And as a federal program designed to impact all 50 states, it's very common for the legislation to define areas broadly so that it can encompass all the different conditions in different states. The favorable tax benefits available to investors in opportunity zones have rapidly given rise to numerous investment fund vehicles in order to try to harvest and make the investments in these areas. This particular cut at defining what I would say a place-based policy toward distressed and emerging neighborhoods really is nothing new. This is sort of the newest version of it. Prior to this, you had enterprise zones and you had the New Markets Tax Credit Program. And since I'm a little older than most people in this audience, I would go back to the Urban Development Action Grant Program, which again was project-specific, but it was place-based. So I offer those introductory comments because both of our panelists this morning we're very fortunate to have because they can speak to both sides of the general issues as well as the detail. Shay Hawkins is a 02 graduate of the business school and legislative assistant for the office of Senator Tim Scott, and he was very much involved in crafting the legislation, and he's going to give us some insights from the Hill on the intent in crafting the legislation and overview how it is intended to work and benefit low and moderate income communities. Also, following him, Ron Moelis, who's a longtime investor in affordable housing, will give us his view as an investor on how the stimulus is likely to work in terms of site selection and funding, and I'll pepper the conversation with questions, as is my role. So, Shay, you want to start?
Sure. First off, I want to apologize. My boss has a strict 7-minute rule regarding text, so I'm not being a jerk by having my phone up here. He doesn't relax the rule for panels, so I have to get back to him with something. Maybe not the answer, but at least I'll look into it, boss, type thing, within 7 minutes if he happens to reach out. Again, as Lynne mentioned, I'm an 02 graduate of Columbia Business School, so it's a pleasure to be able to share, information about my boss's sort of signature provision within the Tax Cuts and Jobs Act. And as we lay things out here, the provision, if you're not familiar with it, can be a little complicated. Feel free to reach out to our office and myself. to follow up with more detailed questions if you feel it's necessary. But just to give a broad overview of how the provision works, and it is a provision. It's not a program. That's one of the key elements, is that we're moving away from a DC focused DC focused process to a state focused process, a locally focused process. That's one of the key elements. But basically, what you have is a situation where, if you are an individual or a corporation that has a capital gain, then you can defer payment of the tax associated with that capital gain for up to 10 years, provided that you reinvest that capital gain in a distressed neighborhood across the 50 states or 6 territories. And so the definition of a distressed neighborhood is taken from existing legislation, the New Markets Tax Credit Program. So it's something that every governor and every community development professional would already understand. Basically, an area with a 20% poverty rate, or an area that has an income level on average that's 80% of the state average, or in a metro area like New York, 80% of the metro average. So that's kind of how we define a distressed area. And what the legislation allows is, it allows for governors or whoever the chief executive officer of the territory is. So, for instance, in DC, it would be the mayor of DC. It allows them to designate up to 25% of the distressed census tracts in their territory or state as opportunity zones. And opportunity zones are just simply areas that allow for this potential special tax treatment. So there's 3 levels of special tax treatment. Again, the one is the one I mentioned, where there's a possible 10-year deferral on your capital gains. The next level is, if you hold your investment long term, after 5 years you get what's called a step up in basis, which is just to say that the amount that you owe is reduced by 10%. And if you hold for an additional 2 years, then you get an additional step up in basis of an additional 5%. And so, although you have a tax bill on your initial capital gain, no matter what you do, it can be reduced a little bit. And so the final benefit, the final potential benefit, is if you happen to discover the next eBay or 1-800-Flowers or whatever, then the gain from the actual investment in the zone, right, is perpetually tax-free if you hold it for 10 years or more. So this is just to say that, given an example, let's say that you're an individual who holds $1 million worth of Microsoft stock. Over time, that $1 million turns into $2 million. So typically, you would owe about $230,000 in capital gains on that, on that appreciation. So what this provision says is, if you take the $1 million gain and reinvest it in a distressed neighborhood, let's say in the Bronx, then you can defer payment of that $230,000 for up to 10 years. Now, you still have that tax bill. At the end of 10 years, you still owe that $230,000. But you can defer it for that period of time. Now, if that $1 million goes into, let's call it ABC Corp, that's a great investment, and that $1 million turns into $1 billion, the real juice of the provision is that the difference between the million and the billion is perpetually capital gains tax-free. So, the key elements from an intent standpoint is that, unlike things like new markets tax credits, enterprise zones, where you're looking at a tax credit on the back end, what this does is draws private capital in. So you're looking at people who are, by definition, good stewards of their resources. That's why they have the capital gain anyway. They're already good investors. They already know how to turn $1 into $5, right? So the idea was to draw their capital in and to encourage them to hold that capital, hence the step up in basis in the long term, and encourage them through some more detailed elements of the provision to actually grow that capital. So the growth is key. You can't just kind of stash capital in a opportunity zone and get the benefit. You have to actually grow that capital, and so that growth, the intent is to lead to job creation in that area, through construction jobs, through through hiring and things like that, general economic activity. And so there's key elements that differ greatly from all the existing community development programs. Typically, these programs are Washington focused. And one problem is you have key players who act as gatekeepers, people who know how to fill out the paperwork, people who know how to move forward in these programs. And the decisions are made from Washington. Here, by allowing governors to designate the zones and say, here are the places where we want to see this economic activity happen. Governors working in conjunction with state and with local and county governments. We sort of exported that process out because people in California know what works best for California. People in South Carolina know what works best for South Carolina. And so that's the first element. But also, allowing the process to be completely driven based on, the 3 non-binding criteria that we gave in the provision, which is we asked governors to look for areas where there was great need. So obviously, the distressed communities, but also areas where there was great opportunity, places where people could turn $1 into $5, because we want the investments to grow so that people get hired. And third, we asked the governors to look for areas where there's mutually reinforcing state, local, and federal programs. So the programs that Lynne mentioned, New Markets and others, we see those as completely complementary in ways that we can discuss later if necessary, to opportunity zones. But then there are also, even as this program develops, there are folks in states that are creating their own programs that can reinforce what goes on with the federal opportunity zone provision. And then finally, what we're going to see is as the provision ramps up, we're going to see the White House directing existing community development programs to favor activity in opportunity zones to kind of give extra juice to what's happening. So that mutual reinforcement is key, and it was key to the selection of the zones.
They're clearly very powerful incentives and designed to be powerful incentives. Ron, will you talk about how you as an investor see this playing out? Is most of the money likely to funnel through kind of private equity funds with a specialization, or are individual entrepreneurs with their own partnerships likely to do it? And how do you as an investor react to this?
Well, first of all, thank you. Pleasure being here. And I think the next panel should be on that 7-minute rule, because that's great. My mind wanders about how that 7-minute rule works, but it's good. So I think that the legislation, which is just evolving, and that was a great explanation, and we got the IRS just published some guidelines about a month ago. There's still more to go because there's a lot of questions in the investment community, and certainly around the money that you make on your capital gains and you're trying to reinvest has to be invested within fairly quick time frames to qualify for this And that's obviously necessary from the government's point of view. They don't want somebody generating capital gains, deferring taxes for 7 or 8 years and investing the money a year or two before the term. So they want the money invested relatively expeditiously. And it makes, I'm only mentioning that because it makes the fund structure more challenging. The guidelines, I think, address some of the issues around the fund structure and gave a little bit of leeway to the funds that are starting to form to be able to do it in a fund structure, but it does present challenges. And we're not only investors, we're also developers, and we have a couple of real estate funds that were not driven by opportunity zones. But with this new legislation, we've been looking at both real estate development that we're engaged in. We do a lot of work, as Lynne mentioned, in the affordable housing and in communities that qualify, that lower income census tract communities in the New York City metro area and some elsewhere. So we're looking at opportunities as developers to use opportunity zone investments in real estate development in these neighborhoods. We're also thinking a little bit about corporate investment. It's not. I'm thinking about that more as an individual investor than I am as from a company point of view. But we're not really thinking about doing it in a fund vehicle. What we're thinking about is we have about 5 or 6 developments that are in opportunity zones that we've been working on for a while. The opportunity zone enhances the investment and also gives us an opportunity to go out and raise capital for these developments that has a long-term vision. So one of the things that I don't know if it was intended in the program. Obviously, part of the intention was to generate activity and job creation and investment in poor neighborhoods or some of these lower income neighborhoods. But also, I think it's going to generate capital that has patience, which I think is really important, that we're going to be able to build and hold property for 10 years and hopefully even longer. The incentives are there for long-term capital, which is not the case for a lot of real estate private equity in general. A lot of that capital wants to turn over in 5 to 7 years, or sometimes even quicker. So I think that generates opportunities for investors, in particular for real estate, maybe even in corporate investment, certainly infrastructure investment, to generate long-term capital with a patient look towards profitability and not a look to just sort of pushing revenues, pushing profits, and being short-term and having short-term thought. And the way, just to finish, instead of doing this in a fund structure, we're looking to generate capital investment in each of these projects, probably from high net worth individuals, more so than corporations, probably long-term capital more than equity funds. And we would go to people who, and there's a lot of excitement around this from the sort of high net worth world where people have pent-up capital gain that they may want to diversify, especially in light of what's happening in the stock market right now. Those who've held Apple stock or Amazon stock for the last 10 years are starting to see some reversal and may want to hedge their bets. They probably were thinking they were deterred from selling because of the high nature of the capital gains, and now they can sell that stock, put it into a quality development that's going to generate jobs and opportunity in a low-income neighborhood, and defer their tax bill and maybe even reduce it slightly for 7 or 8 years, and hopefully make gains over the next 10 to 30 years from the investment in the neighborhood that we're developing in. So that's sort of, and the plan encourages and requires major expenditure in the opportunity zone. So you can't go out and buy an existing building that's, 100-unit building in the Bronx generating cash flow. That doesn't qualify. You have to spend more in either renovating or building, at least on the real estate side. I'm not sure how it works on the corporate side, maybe same thing. But you have to spend more than the cost of the property, than the cost of the building in renovations or new construction to qualify, which means that you've either got to do a fairly substantial renovation or build something new, and those would qualify for the Opportunity Zone benefits.
Eric, I want to just pull out a few of what both Shay and Ron said to reinforce what's particular attributes about this provision. One is it's agnostic with regard to the type of investment, okay, which means that there's flexibility to tailor the investment to whatever the apparent demand and need in the community in that particular district, which it's not pegged to housing, it's not pegged to this or that, and that's, I think, from a community development point of view, really important. Secondly, it's long-term. I was going to ask Shay, is there any sunset provision to this provision? Because when you're dealing in developing communities, and especially ground-up development or serious rehab, spending the kind of money that reminds me of the historic preservation tax credit, where you had to spend X amount more than what you paid for the it's really important that there be patient capital. I mean, that's really what makes communities grow and prosper, is patient invested capital and invested residents. And the third point, which I should have realized, but I certainly realized it from your conversation, is that this can free up capital that is reluctant to sell because they don't want the tax hit, but this allows them, those investors, and particularly high net worth investors, to transact out of one asset class into another, and therefore that generates more capital availability than just, trying to find new capital in a sense. I mean, it is new capital, but it's recycled capital, and from a macro point of view, that's really healthy for an economy, really healthy. So I don't know whether this question is to both of you or one of you, but could either of you identify particular neighborhoods in New York City that have been targeted so we can give the audience a concrete sense of some of these areas?
Yeah, so I can do that. I just want to, and maybe you can comment, Shay, on this. The question you asked about sunsetting. Oh, right. I think that because of the quirks of how Congress works and the tax bills are scored, the tax, I think it sunsets in 2026. The long-term hold goes on for 30 more years, I think. And you can correct me if I'm wrong, Shay, but I think that the way the budget office scores tax bills, there was no cost to the deferral because it was all, the taxes all has to be paid within that 10-year time frame. So the only time there's a cost if there's a tax deferral beyond 10 years. So that made it easier to pay for, which is, I guess, a good thing. I don't understand that really, because there is a cost, but they don't charge for it. What it does do that I think is a negative, I assume there was no way around this, is that the bulk of the benefit is to those who invest in the next 2 or 3 years, because these holding periods start collapsing, and if you invest by the end of 2019, you get 7 or 8 years of holding with the deferral. That's worth something. You also get, as Shay mentioned, the stepped up basis or the reduction in the existing capital gain of 15%. As you start waiting to invest, those benefits start diminishing. And what I worry about as an investor is that is going to be sort of the gold rush to properties and investment opportunities, and people are going to start doing stupid things because they want to get done quickly. So I'll just say that, and then go into your next question, which is, so I think there's a real push right now to, make investments over the next 2 or 3 years in opportunity zones. And maybe if the program works, maybe Congress will extend it and there'll be more opportunity in the future. So New York City, the program presents a lot of interesting questions. Having done most of my work in New York City, the issues in the last 5 years or so in New York City, as those of you who are here and read the newspapers or the blogs, a lot of the issues revolve not around disinvestment, but around gentrification and displacement. I think that those two, when I started 20, 30 years ago, the big issues in low-income communities in New York City were redlining and disinvestment, and communities such as Harlem or parts of Brooklyn, the South Bronx, those communities wanted more investment and were frustrated that lending institutions and developers weren't putting enough resources into their communities. Now, there's a whole debate over whether there's too much investment in, or whether the investment is the right kind of investment in some of those neighborhoods. And we lived through it with some of the rezonings that are going through in East Harlem and Inwood. And we see it in criticisms of the mayor's housing plan and criticisms of some of the dollars being poured into communities that feel that it's contributing to displacement and gentrification. So I say that I'm not making a political statement on one side or another. I'm just saying that neighborhoods like Central Harlem, which parts of it are opportunity zones. Specifically, we have a project that we're working on the 125th Street corridor that is an opportunity zone. And it's a mixed-use commercial residential development. And the residential will probably be almost all affordable housing. And the commercial, obviously, is market-driven. The opportunity zone investment becomes much more relevant in the commercial area because it's a commercial investment. The affordable housing has much less need for opportunity zone money because there's really, you probably could put money in and defer your tax, but there's really no need for equity in very low income housing. The equity comes in through other subsidy sources, low income tax credit, capital subsidy from the city or the state, tax abatements, traditional sources of funding that provide for low-income housing. So our view is that this is a positive because we're still doing affordable housing in a community that's desperate for more affordable housing. And we're also doing commercial and retail development. We're building some cultural space in a community that does have a need for, better service in terms of whether it's healthy food or job opportunities, and the opportunity zone will help create more opportunity for that kind of development and for long-term holds in that area. So now you can take it to its logical extreme, and there are other. Someone might say, with an opportunity zone, why would you do affordable housing? You may as well do market rate housing. And there may be people in that community who would think that's not a good result, but the opportunity zone would lead one to say that's a better place for opportunity zone money. So I think that each neighborhood is somewhat unique. My guess is that going outside of the major urban areas like New York or San Francisco, many communities do want the kind of investment in the neighborhoods that the opportunity zone is sort of encouraging. But I think one needs to be careful of how you step into a neighborhood before you sort of think, okay, this is the cure-all or end-all. I think you have to be sensitive to the community as well.
Shay, I understand that the provision is driven by self-certification. Can you explain to the audience what that means and how, I mean, that came about? I mean, it's basically an entitlement. I mean, if you fit the qualifications, you get it. There's no federal, bureaucracy saying, okay.
Right. And so the one thing that I neglected to describe in my initial comments was there's a vehicle that the investments, that the capital gains investments go through in order to get to the communities, and it's just a vehicle that verifies that what you're investing is actually a capital gain, and that where it's going is an actual designated opportunity zone, right? And so that vehicle is an opportunity fund. And so, again, and the purpose is just those two things, just so we know what's going in, what's coming out. Now, the self-certification process that Lynne alluded to is basically the fact that what we wanted, what we envisioned, was what the sponsors envisioned. Again, this provision was based on the Investing in Opportunity Act, which was a bill that had 88 House co-sponsors and 16 Senate co-sponsors. The leads on the House side were Representative Pat Tiberi from Ohio and Representative Ron Kine, one Republican, one Democrat. On the Senate side, the lead co-sponsors were my boss, Senator Tim Scott, a Republican from South Carolina, and Senator Cory Booker from across the river here in New Jersey. So in any case, what they envisioned was a situation where very sophisticated investors like Ron could pull together could pull together a large fund to do significant projects across a region, across the country maybe, but then also they envisioned a situation where if I get together with a couple of my buddies and we cobble together from our government jobs $30,000 in capital gains, we could support a fourth buddy's business in an opportunity zone, and make a significant investment so they can get started as an entrepreneur. So we wanted folks like me to be involved. We wanted folks like Ron to be involved. We wanted churches, community development organizations, the community banks to be able to raise funds. We've seen a range. So that self-certification process is just to say, look, if you're willing to check in with the government every 6 months and verify that 90% of the assets in your fund, again, that vehicle, are in opportunity zone assets, and the other 10% can be in treasuries or what have you. Then, if you're willing to check in and verify that, then the government is going to, more or less leave you alone beyond that.
Thank you. I've been told this is now time for Q&A. So any tax provision that strives to incentivize investment is inevitably complex. So I'm hoping that many of you in the audience have questions. I think you're supposed to come up to that mic.
Good morning. Thank you very much. So I'm a student here at Columbia. I also work on opportunity zones-based work with a nonprofit here in New York City. And I'm just curious to know, thinking about from the real estate perspective, at the end when it's time to actually exit out of projects, if you have an interest in preserving affordability or having an impact that is more sustainable over time, how do you talk to investors, or what thoughts do you have putting on the investor hat and developer hat as to what would support that long term?
I assume that's for me. I'm not sure I fully understand. I think that the investors who are looking at, I should say many investors who are looking at investing in opportunity zones are looking So what the concern from the investment side is going to be, one, that the investment is a viable investment, so that they don't want, if things go bust, if it doesn't work, they're going to have to pay the tax much more quickly because they're not going to be able to hold it till 2026. So that blows their deferral, and obviously there's no upside beyond the 10-year period. So I think viability is really important, which is not, in many designated opportunity zones, even though it may have been the government's purpose, I think some of those opportunity zones that were designated are not viable development areas, which is a problem. And there may have been political reasons or other why they chose zones versus other zones. If the investment in real estate is viable, then the developer is probably driven to make returns. Mixed income developments can work, and I think that some investors will care about the social impact of their investment. I think many won't, unfortunately. We care, because we're a development company that does have some mission aspect to what we do, although we're a for-profit company. Obviously, nonprofits probably have more, that much mission aspect as well. But there will be a number of for-profit developers who raise opportunity zone money and won't think anything about affordable housing, or won't even think anything about the social purposes behind the legislation. So I'm not sure that the opportunity zone itself creates the incentive for long-term affordability or social incentives beyond that it's encouraging development in lower income neighborhoods. Does that answer your question?
It does. I guess what I'm getting at is, with that in mind, thinking about the project that you described, if you have those affordable units there, is it of interest to keep them affordable long-term, or to allow investors to really see the upside from both the commercial component and those units whenever, as things churn along in that community?
Well, in that particular project, the affordability would be long-term because the subsidy programs we're using to build that affordable housing require that. And that project, that part of the project will be separated, will be independent ownership from the opportunity zone investors. Mm-hmm. So they won't be economically involved at all in each other. The two projects, even though they're in the same building, they'll be separate ownership. But I would say that the opportunity zone investors, other than for social impact reasons, would not be incented to keep things affordable. I mean, the opportunity zone is incenting investors to seek returns, and the better returns are going to be on market-driven investments.
Thank you.
Yeah, and if I could just weigh in on that. So the key from an intent standpoint was to get as much capital as possible into the 8,700 zones across the 50 states and territories. So there's a benefit of the capital going in, from the residents of the zone, from a sort of a consumer standpoint, right, in terms of what their life looks like. But the benefit that we're really driving is for them to participate in the economic activity in the zone. So again, if I buy a Subway franchise for $250,000, right, I have to invest an additional $250,000 in substantially improving that franchise, which means I have to expand it, I have to expand the building, I have to renovate the building, I have to hire more people, right? So that's a requirement. I can't just buy the franchise and walk away. I've got to double what I spent in doing something, some sort of economic activity in the zone, or in a zone, right? So that's what's going to be key. The other thing is by incentivizing this capital, it actually raises the bar for what's viable for everyone involved. So for instance, I met recently with literally 50 CEOs of a national nonprofit organization with representation in every major city, right? This organization holds a lot of property, right? And so what they're looking to do is actually incentivize people who have capital gains, who already support their organization, to raise funds to buy their property from them that they're looking to offload anyway, so that they can then come back in and develop it for affordable housing purposes. Now, these outside folks holding these capital gains, might look at something like this, but this makes this attractive because even if they get, a return of 1%, even if they break even, it still makes sense now, where it previously didn't. So that's the way to look at it. Look at it in terms of the broad economic activity, that's being generated. We want as much capital as possible in as many forms as possible, not just real estate, operating businesses, everything, into these 8,700 distressed census tracts. One other thing I wanted to note quickly: gentrification is a concern, right? And it's obviously a concern for people in this room because we're in New York City. But bear in mind that mathematically, less than 4% of the zones, less than 4% of these 8,700 census tracts are even mathematically, it's where gentrification is even a mathematical possibility. So you have to think about it in those terms too. We wanted as much local control as possible because even in areas where it is a possibility, the local zoning is always going to be a tool. If you don't want a Starbucks in your zone, I'm not to down Starbucks, but if that's a business that brings the wrong type of development, then don't zone for it. At the end of the day, we're trusting local governors, local mayors, more than we trust President Obama or President Trump or Secretary Mnuchin or Secretary Lee. That's the whole idea. And just as a note, the nonprofit that was mentioned here is a nonprofit that we're working closely, our office is working closely with on these exact issues, developing well thought out social impact measures so that once we're 10 years in, or because the provision has so much bipartisan support, once we're 20 years in or 30 years in, we can look back and see how this provision is affecting people who are current residents of these distressed census tracts that hopefully will not be distressed going forward.
Thank you.
Hi, I'm curious on the sourcing side, and you referenced the gold rush mentality. For commercial investors who want to get involved in this, what do you think is the best way to participate and the most efficient way to deploy capital? And I'm also curious, have you seen philanthropic investors coming together with commercial investors to see sort of the double bottom line impact that we're all hoping is achieved?
Well, philanthropic investors you wouldn't have a foundation doing this investment because they don't pay tax. That you might have a philanthropic or a nonprofit development partner in if that's what you're talking about.
That's what I meant. Sorry, to partner up on sort of the programmatic side and the.
So I think the answer to the first question is I think people should be careful. It's unclear from our end as developers or those of us who are putting together funds what the discount should be for us. Like what are we getting a better hurdle rate or a better promote, or what does this mean? I think that roughly the deferral's worth 200 bips if you do it early on, and the upside, the lack of paying tax on upside, depending on what the IRRs are, could be worth another 200 to 400 bips. It's a robust program, But as I mentioned before, you want to make sure you're investing in product that works, because if you don't, you're going to have a pretty bad result on a lot of levels. You pay the tax quicker, you don't get the stepped up basis, and yet there's no upside at the end. So, and some of these neighborhoods are challenged, and unless there are other government programs that complement it, it may not work. And I also think the gold rush mentality we're seeing now, I think the Amazon site in Long Island City is an opportunity zone. So that I'm sure land value there has gone up a lot. We're seeing land value going up in certain opportunity zones where the economics are okay. All of a sudden land value may be going up because people are trying to buy land in opportunity zones thinking they'll have an easier time raising money and they get this extra advantage. So if land was worth $1 million and people are paying $2 or $3 million, that may make those projects less viable. So I think as an investor, you need to be careful from an economic point of view. The second part of your question, which is also a good one, is how do you assure that if you care, and some people will care, they should care, but not everyone will. How do you assure that you're having a social impact, that you're not, buying a piece of property as a parking lot, putting up, paying enough to put up, security booth and qualifying by the rules, but not doing any good in the neighborhood. So how do you assure that there is some social aspect that's a positive? Now, I think what Shay said, some of the underlying goals of the program, job creation, capital investment, that may be good enough in a lot of neighborhoods. New York City's fairly unique, so let's say if you're in, Toledo, Ohio, and maybe there's been disinvestment there, maybe just putting money in to development or business, buying that subway franchise and growing it, or building market rate housing and keeping it stable, those are good results. So New York City, it may be more complex. I think that the nonprofits and philanthropic organizations should take roles in some of these developments and should try to keep people's developers and investors' feet to the fire a bit. And honestly, I think that unless we are careful in the investment community and development community that we do the right thing here, this program won't be renewed. Because if you see a lot of crap being built or a lot of thoughtlessness in how money's deployed in these opportunity zones, you're going to see outrage and it won't be renewed. If you see thought around it and some of the goals that the bipartisan members of the Senate and the House envisioned, maybe we'll get renewal of the program and it'll get extended. So,
are the community development funds playing any kind of role there in bringing together these different stakeholders?
You mean the federal money, the block grants?
Is there any effort to sort of do some of this matchmaking? Or I'm just curious.
I haven't seen it in New York, but again, New York's unique because a lot of the neighborhoods do work economically, and I think the fear is more the other side, that you're going to be doing, that there's too much more investment where they don't want it. I assume that in some of these communities around the country, they're going to join forces with block grants and community, and yeah. Yeah, the problem that we're going to all have, government, no one acts that quickly, right? Things take time. Putting let's just use Toledo again, for a small city to put together block grants or programs to coincide with the opportunity zones in the time frame that everyone's trying to get done. You're going to see a ton of money pouring in the next 2 years. And in probably 2 or 3 years, everyone will get their act together, and by then it might be too late. That's my fear. So I think yes, I think there is. It's taken the IRS, a year to come out with guidelines. They still don't have guidelines done yet. So the sunsetting is disturbing. It takes these programs a while to ramp up. So I think I'm worried that you're going to see more, I don't want to say abuse, because I think it's not going to be illegal stuff, but more cowboy activity where the impacts are not as obvious in some of these places. Some places will be well benefited by it, and some things, because I don't think there's a lot of time for this coordination effort to really evolve. By the time it evolves, hopefully it's not too late. That's my worry.
I think
Thank
we
you.
could easily go on for another half an hour, but I know our time is up. I want to thank Shay and Ron for a fascinating introduction to what's going to be an important provision and incentive for all of us to follow. So thank you very much.